China, the world's second largest economy, has been a major talking point for investors for many years. But recently, after cracking down on companies, China has been thrust even more into the limelight. So while many investors point to China as a rigged game, there are others, such as Cathie Wood, who continue to invest in the country. So in this video, we're going to hear from Cathie Wood in a recent interview, explaining why she still invests in China today, but only a very particular type of company, and why she fears China could bring down the entire world economy. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. Let's jump straight into our first clip.
Touch on a couple of your big investments and also touch on one other theme, which is China, because it's in the news. You have been thinking about that space or that region in a big way, or that country, I should say, in a big way. And I know you've reduced some positions, but what's your overall thesis at this point on China and what we're seeing in terms of this regulatory crackdown, which seems to be worse every single day?
Yeah, I think there's something going on there socially that the government is very worried about. Many of the same things that the rest of the world is worried about, where there's the divide between the rich and the poor. I saw today Evergrande. There are protests around the Evergrande offices because the wealth management products that weren't highly regulated are not paying interest or not paying back and so forth. So I think there's social unrest taking place there. And that's why common prosperity has become the rallying cry, and hostage to capital has also become a rallying cry. So I don't think it's a very friendly place for capital now. However, focused only on innovation, China has, in its various 5-year plans, made innovation an incredibly important plank.
Right.
And so we don't want to avoid it, but what we do want to avoid is very high margin companies. So you look at JD Logistics or JD.com, some of the companies that are pushing innovation and access into tier 2 and tier 3 cities will play with that. So what we did in the series of moves recently around China, we have taken our position down significantly, but stayed with a few of the low margin. What would it take for you to turn?
To invest more? What would you need to see?
What would I need to see? I think it would be Xi Jinping saying, whoops, we made a mistake, we're open for business. I don't think he'll do that. So I don't think we'll be hugely involved with China. The other thing that I think is, and we've seen this in the crypto space, by shutting open source movements down, which is what they're doing.
Right.
All open source movements, no. I think this is going to give the US a competitive advantage. So we have allocated more of our innovation assets here in the US because of what's happening. China was going to be one of our biggest competitors. We saw them in the AI space, making the league tables in chips. I'm not so sure. I think they have to do some house cleaning right now that we probably do not understand all the causes, but I think there's social unrest. That would be my guess.
And you think, let me ask this, do you think that the regulatory environment there is either going to open up opportunity in the US, or will it give and embolden regulators in the US
to shut it out? To
shut down what's happening here? Because it used to be that the big tech companies in the United States would say, well, no, you can't shut us down, because look over there in China, those companies are so big, we need to compete with them. But if they're being shut down or cracked down upon, will it just embolden Washington here?
It's a good point, but I think this is much more than China. As Rupal on the last panel said, France is becoming very innovative, and Southeast Asia has stolen the march from China. So companies like Sea, it's a social media, social commerce, gaming company. It's exploding throughout the world, and capital is shifting towards that kind of name. Because there are big populations in Southeast Asia and Latin America as well.
We also think there's another fear brewing out there, and it's China. Now, we hear a lot of headlines about China, But I'm not seeing many economists even integrate what's going on in China into their forecasts. China has been a powerful growth engine for the global economy for the last really 20 years. And they are changing their spots. Growth does not seem to be China's primary objective anymore. Common prosperity does. And they are restructuring in many ways. I think that's going to slow things down quite a bit, their economy. And of course, China has an impact not only on the rest of Asia, but especially Europe. I think Europe and China are much bigger trading partners than China and the US. Nonetheless, commodities are global. And so what hits China and these other economies is going to impact pricing.
Yes. You've been in, you've been out. And sometimes we're trying to understand.
Yes.
So how are we supposed to look at China right now? And the clampdowns that we've seen in the government, certainly on different sectors that have just decimated those sectors in terms of the value of them.
Yes.
So what do you expect kind of to be your involvement?
Yes,
an investment play.
Our first move away from China was when China was had a very strong move, and the innovation there was being deeply appreciated while ours was not. So that was that kind of move. The second time we moved in, then we moved in. Why? We saw the reaction to COVID, and we got more interested because it was the most disciplined country in terms of both monetary and fiscal policy during the crisis. And I thought that China had the possibility of becoming the Germany and Switzerland of the world, in terms of discipline, monetary and fiscal. As soon as Jack Ma was banished, effectively, last November, we started pulling back, because what we're doing, and especially during February through May, where our strategy, just to give you a sense how volatile it is, our strategy from mid-February through mid-May, most people wouldn't admit this maybe, but this is how volatile we are. Transparency was down 37%, peak to trough. So we have come back, but during that period, what we do, as we always do, we concentrated our portfolio towards our highest conviction names. China was moving away because almost every week and month there was a new regulatory move or crackdown. And so it was easy to do that. It was great because I'm always scrambling, looking for cash during a correction. Okay, where's the confidence lower? Where let's buy into some of these, our favorites here. Now, common prosperity. So what have we done? No China in our flagship. We do own some China in a few of our portfolios, the ones focused on autonomous technology and robotics. But we're very particular. Very low margin companies, because margin is clearly not appreciated by the government anymore. Common prosperity. And very beneficial to tier 3, tier 4 cities. Common prosperity. So JD Logistics, JD.com, Pinduoduo.
Does it stay this way, do you think, in China for a while?
Well,
I mean, it's hard to say, but China is certainly a country, when they make a decision, it's longer term. It's longer term planning. And President Xi certainly seems to be on this mission.
And I think he is very unsettled that the 3-child policy is not working. And so there's a big social engineering, and by the way, this was all very forecastable, right? I mean, demographics, they knew 50 years ago what was going to happen. So I think that's part of it, and there are the haves and the have-nots in China, like there is around the world. I think China's taking it more seriously because there's probably more social unrest than we now appreciate. What I don't understand is they're going after real estate, which is 75% of the consumer savings in China.
Individuals in China.
And if individual saving. If the prices are going down, which they have been, I think that could really hurt consumer confidence. I think it already is. And then last weekend, or the weekend before, the government, the national government, went after the regulators who had focused on the financial industry, as well as the financial institutions. And I'm just saying, wow, they're playing with fire.
It's a moving, yeah.
And talk about a cyclical risk out there. Think about that if we lose China. At the margin, China has been responsible for a tremendous amount of cyclical growth.
Right.
And
exactly.
commodity price inflation.
So Cathie makes some very insightful points in these recent interviews. There are two main points that really jump out at me though. The first is that she believes China is still investable, but you have to be very particular with the companies you choose to invest into. And the second is how she believes China's recent moves could have a major negative knock-on effect for other economies around the world. So in the past few decades, China has opened itself up to the world. While their ruling party's name might imply otherwise, they have been on a path towards capitalism for many years, and this has led to great prosperity for the country. The poverty rate, for example, has fallen dramatically in recent years for Chinese citizens. However, over the past 12 months, their tune has changed. Instead of focusing on the growth offered by capitalism, the government has stepped into the market more dramatically than they have done for many years, and all in the name of common prosperity. And this is the key point that Cathie highlights. China is now focused more on common prosperity than they are on growth. So, what exactly does this mean? Well, for a start, if you want to invest in China, you better be picking companies that are helping the country achieve this goal of common prosperity. Cathie, for example, names companies that are low margin and companies that are pushing innovation in tier 2 and tier 3 cities. These companies will ultimately assist China in achieving their goals, and therefore there is less incentive for the government to step in and intervene with these businesses. Although, of course, we must still consider the risk of government intervention for all companies and factor this into our valuations. And then the next question is, how will this impact the world economies? As Cathie puts it, China's growth has been like an engine for the world, driving prosperity in many more countries than just their own. As they focus less of their attention now on growth, this could ultimately hamper economies globally at a time when they need growth the most. Although the counter-argument to this is that China's latest moves could ultimately present the US with an opportunity. As China clamps down on their tech giants, the looser regulation in the US makes it even more appealing than before as a place to launch a technology company. Now I'm interested to know what you think. Do you agree with Cathie that China is still investable, or are you avoiding the country entirely? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.